Hey everybody, Bob Knakal, Chairman and CEO of BKREA coming to you. Welcome to the Bob Knakal Show. We are here in the Knakal Map Room 2.0. Welcome to the show. We have an unbelievable show for you today. Our special guest is the Chairman and CEO of Time Equities, my good friend and a client for many, many decades, Francis Greenburger. Francis has an incredible story and can't wait for you guys to meet him and to hear what he has to say. You're going to be really in for a great treat today, and I couldn't be more excited to have Francis with us. Thanks so much. And of course, we have to say thank you to our major sponsor, Crexi. So I have to tell you, we use Crexi every day. Our whole team here at BKREA does one thing and one thing only. We represent sellers and we represent them exclusively, and all we try to do is maximize the sale prices that they get. How do we do it? We use that great tool, Crexi. Almost everybody in the office is on that almost all day long as we figure out where to find that next buyer that could possibly pay the highest price for one of our clients' properties. Crexi, it's the most powerful platform on which you can prospect, evaluate, connect, and close any commercial real estate transaction. Thank you so much to our good friends at Crexi for sponsoring the show. Welcome. Let's get to it. Hi, everybody. I'm Bob Knakal. Welcome to the Bob Knakal Show. I'm your host, Bob Knakal, the Chairman and CEO of BKREA. So happy you're able to join us today. We have a great show for you. We have as our special guest, my good friend and client, the Chairman and CEO of Time Equities, Francis Greenburger. Francis, welcome to the Bob Knakal Show.
It's great to be here, Bob.
And I have to tell you, I don't know that I've ever shared this story with you, but back in 1984, one of the highlights of my career was joining the Real Estate Board of New York Sales Brokers Committee. Back then, it was very, very difficult to get on the committee. They only accepted 2 people per company. Fortunately, Coldwell Banker didn't have anybody on the committee, so Paul Massey and I were able to join. And we were always so happy to look forward to going to these luncheons and meeting these people. And I remember the day that you were speaking. And Paul and I were just so thrilled. And we're like, oh my gosh, that's Francis Greenburger, the Chairman of Time Equities. And you gave such a riveting talk about the business. And it's something that I will never, ever forget. And it was probably in 1985.
My goodness. Thank you for remembering that.
No worries. But Francis, you have such an amazing story that I want you to share with folks. And let's talk, you're a born and bred New Yorker. Tell us about, and I have to mention also the author of Risk Game, a great book on entrepreneurship. The real estate business is so entrepreneurial. Great book. Get the book. I can't wait to read it. But Francis, tell us about growing up in New York. Was it Forest Hills that you grew up in?
Yes, I was born in Manhattan, opposite Gracie Mansion. But when I think my parents moved to Forest Hills when I was 2, and I spent the next 12 years there. And Forest Hills was a good place to grow up. It's a sort of a combination of smaller buildings, private houses, and 6-story apartment houses. So sort of a very typical kind of New York landscape.
And as a kid, what were your activities when you weren't in school? What did you enjoy doing?
You know, I, for whatever reason, had this entrepreneurial thing in me. I think when I was 8 years old, I had some cards made up that I would shovel snow when it snowed, and I would do odd jobs. And because there were a lot of private houses, when it snowed, I would go knock on the door, and people wanted their walks shoveled. That was how I started out.
There you go, the seed capital for buying real estate from snow shovel.
And then when I was, I don't know how old I was, but I delivered newspapers, and 20 years ago, I built a building next door to a building that I remembered delivering newspapers to. So
there you go.
What comes around goes around.
That's right. So, and you got into the business world very, very young. Was your first job, you were 12 years old, is that right?
I was 12 years old. I was my father's bookkeeper. He had a very small business.
A literary business?
Literary agent, publishing, represented writers. And so after school, I would trek to his office, and everything was manual and added and subtracted numbers. He wasn't a great businessman, so he had some debt problems or debt issues. So I learned to manage debt at a very young age, which was good training, even though I didn't know I was going to go into the real estate business. But as you know, debt is an integral part of the real estate business, so I got started early.
And at 16, you learned the lesson about real estate that kind of catalyzed and got your real estate career going when you needed a home for a business that you were running. Why don't you tell that story?
Separate from my father's business, I started this book distribution business, very small business. But I did need a one-room office. And so I looked around, and there was a couple of blocks. My father's office was at 57th and Madison in the Fuller Building. So I wanted something nearby. And I saw that there was an office available on 59th Street between Park and Lex, but it was in a walk-up building. And I went there, and the owner showed it to me. And he says, well, I really have two of these offices, and I want to rent them together. And I said, well, I can barely afford the rent on one of these. He said, I'll give you a very good deal, and you'll find somebody else, and you can sublet the other room to it. So I didn't know better. I said, okay. And then as it would happen, a couple of days later, I found some guy who was looking for an office. I showed him the smaller of the two offices. He rented it and paid a rent that was equal to what I was paying for both offices. So now I had a free office, and the light went off that maybe the real estate business is easier than the book business, which had very small.
And this was on 59th Street in Philip Rudd's building, right?
Philip Rudd was the owner of the building. That's correct.
Interestingly, for the folks who are at BKREA that are here, we are now selling that piece of land. Those buildings have been demolished at 118 East 59th Street.
Correct.
We're selling the land for $450 a buildable foot, and probably your rent was a minuscule fraction of that.
Probably, $4 a foot.
Right. So unbeknownst to you, you probably were the predecessor of WeWork in the way tell us about the deal at 114 East 28th Street.
Well, yes, unbeknownst to me, but so, I had this model of renting one-room offices, and a friend of my father's had elevator building on 28th Street between Park and Madison, and Park and Lex, and he was having trouble renting space, and my father said, "Oh, my kid's doing this, my kid's doing that," and so I got introduced to him, and he said, "Well, do you think you could do something?" I said, well, let me try. And so I made a deal with him. I master leased the building and then rented it out, sort of one room at a time, occasionally two rooms. So it was an early version. And I'd done 3 or 4 such really leaseholds, just like WeWork. They didn't own the buildings mostly, and rented it out in small offices. That's how I got started.
And that was in the early 70s?
No, it would have been actually mid-60s, late 60s. And then in 1972, they had changed the rent control law in 1971, and they were you could decontrol vacant apartments. But people were so discouraged about, and you I don't remember when you got started, but
84.
So that's already later. But people were so discouraged that even though they had liberalized the law, people had lost their entire savings owning buildings. And so they were just willing to sell them to anybody. And the fact that the law had been liberalized in an important way just didn't register with them. And so I started buying these residential buildings.
What was the first building you bought?
23 Barrow Street.
What kind of building was it? How did you come up with the money to buy it?
It was a 5-story tenement, probably 4 apartments to a floor, so 20 apartments. I think I bought it through High Shermer. Not sure whether that's correct or not, but anyway, I got a friend of mine. Father was a dentist, classic real estate investor. He put in a little money. Phil Rudd, who I had rented the space from on 59th Street, he put a little bit in, and I somehow, I don't know, got a few bucks. And so we cobbled it together, classic syndication. And that was the first building I bought. And I'd promised the investors, I think, an 8% return or something. And the building wasn't quite making that. So I felt badly about it. But somebody said, oh, well, you could sell it and get, I think I bought the building for $50,000, sold it for $70,000 so I could deliver a return to people. And so I sold it actually to a policeman.
Well, that's probably a doubling of the equity. 2x multiple on the equity.
Exactly.
That was a good one.
Exactly.
So one of the things I love doing when talking to the young folks is to talk historically about, I go back to the S&L crisis and the recession in the early 2000s, but you lived through the mid 70s when the city almost went bankrupt. And I think that the headline in the New York Post, Gerald Ford, the city asked the federal government for a bailout, and Gerald Ford famously said, "Go to hell," to New York. So what was it like in New York City real estate in the mid 1970s?
Basically, there was almost no bank financing. So any deal that was done with seller financing, purchase money mortgage. As it happened at that time, Phil Rudd, who I'd met renting the space from, father-in-law had owned a factory in Brooklyn, which was condemned by the city, and he got an award in condemnation. Then there was litigation. Anyway, eventually he got an even bigger award, 1975, but the city didn't have any money. So he had, in effect, a judgment against the city for $500,000, which was at the time a huge amount of money, but they just didn't pay. And, you could stand on the corner and scream or whatever you wanted to do. So, there was this period where they're sort of teetering. Once in a while, they'd make a little payment. Here's $50,000, here's $100,000, which we would then use to go and buy more buildings. So that was sort of the beginning became a larger portfolio that I put together.
Got it. And so, today everybody wants to buy condos and everything is condo. Used to be condo conversions before HSTPA killed that, but converting buildings to condominium ownership, people want to buy condos. But back in the old days, it was co-ops. And, Francis in his career has converted over 100 buildings, over 10,000 apartments he's converted. And let's go to 1979. You buy a portfolio of 15 buildings from Milton Newmark?
Not from Milton. Milton was my investor.
Oh, okay. I'm sorry.
I bought it from Gene Warren was the broker, but I can't remember the seller's name, even though we became friendly. And he owned a Jacobs was his name. And his family had owned a portfolio of buildings in the West Village, 15 of them. And it was a long, complicated negotiation. But in the end, we bought them. And another one of my investors in that, in 79, he was a lawyer, certiorari lawyer, but he also did co-op plan. So he said to me, well, why don't we try to co-op one of these buildings? I didn't know anything about co-ops.
Bethune Street?
Bethune Street, exactly. So we put a plan in, and we didn't hear a word from the tenants. And then just towards the end of the process, I guess just before maybe the AG approved it or something, there was a 5-page letter how the plan was fraudulent and we hadn't disclosed in those days. Remember Westway? There was a plan to put an elevated highway down the west side. And there was a lot of rancor in the West Village because they didn't want this. And they said, we didn't disclose in the plan that this Westway was planned. And they felt that that meant we hadn't made full disclosure, which was the legal requirement for the plan. Anyway, I thought this isn't going anywhere. But over the course of the next few months, a couple of people moved out, and we were able to sell those to outsiders. And because that was 2 out of 10 apartments, so that was 20%, and the law was you could declare it effective if you had 15%. So we were able to declare it effective. Can't remember exactly what the pro rata price of the building was, but probably we paid, $35,000 or $50,000 for the building. So that meant for the 10 apartments, $5,000 or $10,000 an apartment, and we sold them probably for $50,000. So I thought that was pretty good. Anyway, multiply that by the next 6 or 7 years and 100 buildings and 10,000 apartments, and that's what I was doing in those days.
Yeah, unbelievable. And I think it's so interesting to see so much is happening in the world today in New York City. Yes, we have the 485X program, 467M, UAP. Things are changing the world very significantly, but some of those conversions you did were enormous. Clinton Hill, I think, was 2,100 apartments. Tudor City, 2,300 apartments. What was it like to do those conversions on those massive projects? And then what happened with tax reform of 1986? And maybe explain a little bit about how you structured those conversion deals and how the tax reform of 86 impacted things for you.
Well, that's a lot of questions, but I'll try to.
That's my job. I got to give you a lot of questions.
I try to break it down. So one of the things that I sort of did in the co-op business, which at the time, prior to 1980 or 1979, the notion, there were two kinds of co-ops in New York, condos. There was buildings on Park Avenue, very high end, Fifth Avenue. And then there were low-income co-ops that had been developed by other city programs or unions. But the notion that sort of middle-class people would be buying apartments in walk-up in the West Village seemed bizarre, or other sort of middle income. And in the early 80s, I think in 1981 or 82, somebody offered me this project called Clinton Hill Apartments, which was 1,200, not 2,100, 1,200 apartments spread over 13 buildings. And it had been owned by a guy, Sidney Levy, who had syndicated it 15 years before, and he had 1,000 investors or something. And he was afraid, he was aging, and he was afraid that he was going to die, and then his wife would have to figure out what to tell these 1,000 investors. And the buildings were having typical rent control issues, unable to meet debt service, et cetera, et cetera. So I entered into an option deal with him. So I didn't actually buy it. I said, okay, well, I'll pay you. He wanted $12 million or something, which was, I guess, 10,000 an apartment. I said, well, if you give me an option, I'll put a co-op plan in, and then if I succeed. And that building, which had been built as housing for the Brooklyn Navy Yard, but over the years it had changed, and it was now had become sort of a middle or sort of upper middle class neighborhood for Black families. So a lot of Jewish people aspired to go to Forest Hills. Many Black families aspired to go to Clinton Hill. But that was not your typical co-op buyer, as people thought. Anyway, I took it on, and sometimes I thought I was crazy. A lot of people thought I was crazy. But when it all came to pass, we sold enough apartments to declare effective. And now it's, 40 years later. So in those days, I offered insiders could buy their apartments for $12,500 above the debt, which really meant they were paying, I don't know, $25,000. Or outsiders could buy it for effectively $35,000 or $40,000. Today, apartments there trade for $1 million. I still own, I think, 150 or 200 of them. We've been selling 1 or 2 a month for the last 15 years. Well, that's a lot of money.
So that $1 million. The IRR is infinite? You have the infinity sign for IRR for that one?
It went through many ups and downs, endless problems, pain. You talk about the savings and loan crisis, which affected the entire real estate business. This would be sort of, you had the Tax Reform Act in 1986, which changed the valuation of real estate, because in those days, real estate was valued for its economic value plus a premium for its tax value because there were tax benefits to be derived. In 1987, they changed the law and those tax benefits went away. So that premium went away. And that premium was significant. It might have been 30 or 40%.
And just to explain for those of you, many of you are probably not familiar with this, but those deals they were basically tax driven. If you look at multifamily apartment building sales in the 1980s, the buildings were selling at 12 times the rent roll, 13 times the rent roll, which made no sense economically, but they were bought mainly for conversion to co-op. And what an operator would do is basically sell off 15% of the units, get the plan declared effective, continue to sell units, and you were left with a bunch of rent-stabilized tenants who wouldn't buy and wouldn't move out. And you would then take those units, and if those units were worth $1 million, you got a $900,000 first mortgage on them, a $100,000 second, a $75,000 third, and a $25,000 fourth mortgage, and you had $1.2 million of debt on something that was worth $1 million. And you sold these tax credits to dentists and lawyers, and sometimes it was the 2-for-1 write-off, and sometimes a 3-for-1 write-off. And then if one of those tenants happened to leave, you'd sell the unit for a big money. And so that was a big business, but that business was completely crushed by tax reform of '86, and all of those tax benefits went away. So a lot of folks were left with $1 million worth of apartments that they had $1.2 million in debt on, and it really had tremendously tumultuous impact on the market.
It was a factor, certainly, but it was a factor nationally. I remember the first awareness that I had of the severity of the situation. I had some a developer from Texas, it was like a Bill Clinton lookalike, came to see me. He had been in the Air Force. He came out. The S&Ls were just giving you all the money you needed, and he had developed all kinds of things. Well, his day of reckoning had come. So he got introduced to me by a banker who wanted me to help him with an asset that they had financing on that was troubled. And I ended up going to Texas. And that's where early on, because there had been so much overbuilding there, it was more evident than in some other places. Then the rest is history. And yes, it affected the co-op market in New York, but it affected the entire real estate landscape from across the country. And then that perpetuated the savings and loan crisis, where we closed. The U.S. government closed 2,000 banks. These were smaller banks in a period of maybe a year or two. Government had these planes. They would fly a squad of bank inspectors into whatever town this S&L was in. They'd go to the bank. They'd tell the staff that they had to leave. They'd put a sign, bank closed, and then they'd get back on the plane and fly somewhere else, close another bank. It was, something that we think of maybe from the 1800s.
Yeah, from my perspective, that was the absolute worst time. Even the GFC was nothing compared to this. And those same apartment buildings that we were selling for 12 and 13 times the rent in the mid-'80s for co-op conversion, we were selling as foreclosures for the Resolution Trust Corporation for 2 and 3 times the rent. That's how much values had gone down.
I'd have to check the accuracy of this. But I think almost all the larger public real estate companies, they weren't REITs exactly, but they, some of them owned insurance companies and S&Ls, but they were primarily real estate oriented, all went bankrupt. So it was the depression in the real estate business. It wasn't even a recession. We had endless problems.
And Francis, is that what I was going to ask you next was, your start as an owner was in the multifamily sector, but today you own all types of properties across every product specialty. What was the thing that got you out of, was it tax reform of '86 that got you started looking at other product types? Or what was it that made you transition from buying apartment buildings to looking at other types of assets?
Well, I own probably retail, office, and residential in New York City. So it really was a decision to diversify out of New York as much as product type. And I remember, I think I bought my first shopping center in Connecticut in '85 or '86. And friends in the New York real estate community would say, well, what do you know about shopping centers in Connecticut? I said, look, I don't know anything. Fine, I'll make some mistakes. But I know it's a mistake for me to be overly concentrated in New York. So for whatever reason,
A lot of folks today wish they had that mentality.
as you know, today we own property in 37 U.S. states,
7 countries.
7 countries, and we own about 350 buildings of every product type.
Talk about your
hotels.
your first acquisition in Montreal that you bought a building for $8 a square foot.
So I had been dealing with a broker in Montreal. His name's Clifford Letofsky, not that it matters. And he had for sale 2 industrial properties in Syracuse, New York, which they were leased to a big trucking company, and it was a very high cap rate. And basically, there was 5 years left on the lease, and you could amortize the entire purchase price out of the rent over the 5 years. So at the end of 5 years, even if you were just left with nothing, you had gotten all your money back. And so I bought that from him. The seller was Sam Zell. How Sam Zell how owned these 2 junky buildings, I don't know. And P.S., I still own them today.
Oh, fantastic.
But
Now,
anyway,
so you paid $8 a foot. What's the rent today per foot?
no, these were the industrial buildings.
Oh, okay.
I think I paid, I don't know what I paid, $2 a foot. It doesn't matter. But that same broker said, you should come up to Montreal. We've got a lot of distressed property market in Canada. This was 96, and take a look around. And so I went up there and I said, well, let me meet with some real estate people, some bankers, some city planners. Let me get a sense of what was going on. I had heard about the separatist movement, but I didn't pay much attention to it. But at that time, Quebec was thinking of leaving Canada, being set up and there was a very strong political movement there. And we had a very civilized lunch. Everybody was nice. And then over dessert, the people who were part of the Quebecois started fighting with the English-speaking people. I realized they were crazy, and I left. And then 3 weeks later or 4 weeks later, the broker calls me on the phone. I'm just about to get on a plane going to Switzerland. And he says, I've got one I think you're going to like. I said, well, what do you got? He says, well, it's a 320,000, they called them needlecraft buildings, but it's only 20 years old. And it's in a good location. He told me the location. I sort of knew it was like the West Broadway of Montreal. He said, this is owned by the Brofmans, who were the most prominent family in Canada, and they have all left Montreal. That's where the Brofmans used to live, but they didn't want to have anything to do with the Quebecois, and they had all gone to Toronto, or some of them went to Israel, I think. Anyway, this was either their last building or the last of 2, and they just want it sold. And they were willing to sell it for nothing. I said, well, okay, $8 a foot or whatever, $8 a foot. He said, well, you have to come here tomorrow morning and see the building and sign a contract. I said, well, I'm getting on a plane to Switzerland. He said, otherwise the deal will be gone. So I got somebody in my office to fly up there, called me, made the deal, and today the building. So I think we paid 2 million Canadian, and as was said before, Canadian dollar was 65 cents in those days. Eventually it rose to $1. Now it's back to 70. So what goes up also goes down. Anyway, the building is still own the building, and it's probably worth $60 million or something. This was 1997. And then I ended up buying as many buildings as I could find because they were so cheap. And some guy read about the one that I bought from the Brofmans in Montreal. He had bought a similar size building, I think 250,000 or 280,000 feet. He bought a tax sale on a property in Toronto, which had been financed by a syndicate of American banks, and they wouldn't pay the taxes. And they lost the building. Mortgages were 100% wiped out, and it was the taxes were sold at a discount. And this guy bought it, but he didn't have any money. He called me up, and we partnered with him, and we own that building today, and it's also worth 60, 70, 80 million bucks.
That's great. So Francis, when I announced that we were going to be doing this show, I mentioned on social media that we were going to be filming, and you were going to be the guest, and we had several people write in questions. So, I have some questions for you that your fans want to hear about. So, first question, which I thought was really interesting: would you rather own 100% of a $10 million asset or 10% of a $100 million asset?
Easy. I would own 100% of a $10 million asset. We do a lot of partnerships with a lot of real estate owners and developers all over the country, but we always own at least 50% and usually more.
Got it. Okay, you want to have control.
We want to have control, or at least we want to have an equal seat at the table. So it's either 50-50 or we have more, but I don't take minority interests.
Next question. What's the biggest threat to the New York City area real estate-wise over the next 10 years, and what's the biggest opportunity?
Well, I think there are two threats. One, as we all know, there's been a huge repricing of office buildings in New York City. And that has caused enormous losses of value, which has been either absorbed by owners and in some cases banks, because value decrease cut even into the first mortgage portion of the stack. That also has implications because of tax assessments. Now, the city of New York doesn't really have any formal, they pretend they do have a formal protocol. So they have reasons to increase taxes, but they rarely have reasons for decreasing taxes. So the fact that the value of the building fell in half doesn't impress them mostly. So we have an erosion of the tax base that's at issue on a public policy level. And of course, we have the impact of all of these office buildings that are going through, many of them through, not all of them, but some of them, through financial disruption and what that all means and how that gets played out. At the same time, it's my view that the reforms that occurred in residential rent controls they were always bad, but they at least had a mechanism that allowed the private sector to hope that there was a future. Now it's the reverse. Most rents are, depending on the particular statute that applies, but rents in many buildings are lower than increases in costs. So it's kind of an accident waiting to happen. And the cash flows are not only not increasing, but they're going down. So that's another recipe for disaster. And, politically, that was expedient for the government to have those regulations, which they passed or made worse 4 or 5 years ago. And that's also something that is a danger to the city and the tax base. And, we've seen what happens to housing when it's under-resourced. In the 70s, many owners just abandoned buildings in New York for the same reason. Thousands, tens of thousands. So these are fundamental structural issues that have to be addressed or changed. And so far, we don't see the political will to do that.
Yeah, so, Francis, before we get to the opportunities, let's just look at this B and C office sector for a second, because everybody's talking about it. Values per foot are where they were 20 years ago. Rents per foot are where they were 20 years ago, but taxes are triple where they were 20 years ago. Is there a route out of this?
It's complicated. And the other part of it is, not only do you have the very high taxes and operating costs, but the balance of power between tenants and owners is such that when tenants rent space, the tenant concessions are so expensive that the economics of renting the space are marginal or zero. There's a disbalance in the marketplace so that even if you fill the building up, you're not really getting a return on the real estate value, even the lower real estate value. So it's very complicated. There are a number of people who have decided that the pricing is good enough opportunity and the buildings are trading at least half of what they used to trade at. But it's a real conundrum. And outside of New York, again, depending on the market, the economics are a little better. Now, we haven't bought an office building in a few years. We're buying one right now outside Philadelphia near King of Prussia, which is a very strong market, but at less than half what the last owner paid for it maybe 5 years ago. Typical of what's going on in the marketplace. This has some very strong characteristics, including very strong in-place tenants. So it's economic, but it's complicated.
So, Francis, where are the opportunities today in New York City?
Well, that's a good question. So, I have not been a big buyer in New York for a long time, as you know. We are in the process of looking at one building in Brooklyn that some of our folks at Time Equities think is interesting. It's not really a bank workout, although we're paying, I think our price is close to the debt. A relatively new building. I have some ideas right now in New York, as you probably know, you cannot convert apartment houses to co-op or condominium unless you have 51% of the purchaser, the people living in the building buying.
Which makes it virtually impossible.
Virtually impossible, but I'm crazy enough to think that maybe in the right circumstance, there might be an opportunity to try that. So we're looking at this building because it makes enough. It's not a great deal, but it's okay. It's probably positive, slightly positive leverage at today's interest rates. So we're buying it somewhere in the probably high sixes in terms of cap rate. I have an eye on it. I'm not sure, but that it might be one to test the market and see whether it would be possible to sell at least 51%. That's
See, like decades ago, you have to make a deal that's contingent upon you getting your plan effective, right?
something like that.
Okay. Last question. If you were in your 20s, how would you launch a commercial real estate investing business in today's environment?
Well, I think the world hasn't changed that much. The business is more complicated than it was in all respects. Insurance is like a whole world into itself. Mortgages, many, many highly skilled lawyers stay up all night working on behalf of the banks, thinking up new provisions that they can put into mortgages, which are very complicated. And half the time, many lesser skilled lawyers don't even understand them. So you really need a high skill level. However, same rules apply. If you can find a really good deal, I used to say which I didn't do in the end, I used a different title, but I used to say I was going to write a book about real estate. I would buy it right. It's the only chance you'll get. Because if you overpay for real estate, you're stuck with that. And it's very hard to work out. So, but as we know, as we've just discussed, there's a lot of discounting going on. When real estate has problems, valuations fall dramatically. So if you can figure out how to solve those problems, it can be accretive. So if I was a young person, I would look for such a situation where the price is low. There's a problem that I think I can solve. We're just buying a building in Boston that last traded for $65 million, and the last owner put in $15 million in improvements, $80 million. We're buying it for 13. And it's in a very high traffic, very good retail location. And we're in negotiation with a major tenant, retail tenant, to take it. So, that's an example. So if you can find that problem, that nugget, and the price is right, and then you can solve the problem, that's accretive. And, where do you get the money? Usually when you're young, you start out with family and friends. It's not magic.
That's the way to do it. Well, I want to thank our studio audience for being here tonight. Francis, thank you very much.
Bob?
I was in awe of you in 1985 when you spoke at the Sales Brokers Committee at Rebney. I'm still in awe of you.
Well,
Thank you so much for
I'm in
being.
awe of you.
Well,
And
thank
I'm in
you.
awe of your incredible
The map?
the map. Where we talked about, there's a model of New York City that a three-dimensional model in the Queens Museum, which is an extraordinary thing to see. And it's in a huge room. Well, your map, as I told you, reminds me of that. Different version.
Well, thank you. And that's the Knakal Map Room 2.0. If you'd like to come see the map room, please give us a call. As I always say, you can email me at bk@bkrea.com or call me at 917-509-9501. Until next time, we'll see you. But thanks for joining the Bob Knakal Show today. Take care, everybody. Hope you enjoyed the show, guys. You don't want to miss the next episode. Please subscribe. And don't forget, there's an opportunity to be in the live studio audience. So follow us on social media, and we'll make announcements about when the next filming is going to take place. We hope you enjoyed the Bob Knakal Show, which again was presented by our friends at Crexi, the most powerful platform on which to prospect, evaluate, connect, and close any real estate transaction.